Ora si registrerà la conferenza.
Many thanks to Vitor for having accepted our invitation to give a presentation on a paper which was in the program of the Consob ESMA bocconi conference planned for last March, but unfortunately cancelled because of the pandemic. Many thanks also to the other co-author, Christoph Kaser, who joined us today. Vitor is going to present a paper which is about a topic crucial to Consob, very interesting. So I don't want to go to spoil your presentation, so please, the floor is yours. Unfortunately, I won't be able to attend, to participate for the whole seminar because of another call that I have to participate in, but I will manage to listen at least to your presentation. Thank you very much to Vitor. Thank you very much also to the discussant, Professor Rocco Ciciretti.
So yeah, thank you so much for the invitation. It's a pleasure for me this presentation in this very difficult times. So I'm very glad to present our paper, Investor Sentiment and the Time Value Sustainability Premium. This is a joint project with Christoph Kaser, who is also in the audience, and Lucila Campos. We are from the TU Munich, and Lucila Campos from the Federal University of Santa Catarina in Brazil. So the agenda that we are going to have today, very standard. So motivation, talk about the paper, data, and so on. And the results are going to be based on 3 parts: about what happens with this sustainability premium in the long term, what happens in the short term, especially with regard to investor sentiment, and then we talk about this sustainability factor and the conclusions. So basically, what's this paper about? So maybe one of the most important questions we have nowadays is whether investing in social and environmentally responsible activities have a positive, neutral, or negative effect on the financial performance of the firms. And there are reasons to believe in these 3 possibilities, because maybe the most straightforward is the positive effect, because people know that if you can create a lot of value by investing in CSR, by having a better relationship with stakeholders and so on, and even create some competitive advantage by investing in CSR and CER activities. This is more from the past, but in particular in the 70s, 80s, and 90s, were more common to have some papers telling about a negative effect. And the idea is that basically the firms could waste some of their resources to invest in CSR. And this investment should be bared by the governments or by others, and the firms are just wasting money. This is not the view anymore, but this is also one of the possibilities. And the third possibility would be like a neutral effect. So the idea that the market is competitive, and even if a firm has some competitive advantage with some CSR investments and so on, or I mean some economic profit by investing in CSR, the competitors also could see the case and also investing in a similar activity until the economic profit disappears. And when we go to the empirical evidence, the results are also mixed, not surprisingly. So among the papers that find like a positive relationship, there is, for instance, the paper from Lins et al. In the Journal of Finance that basically shows that firms with high CSR activity have a higher returns, but they test this in periods of crisis, so in 2000 and 2008. And when we talk about the negative relation, for instance, there is this classical paper from Elgo et al., Journal of Banking and Finance, that finds that higher CSR leads not to higher returns, but lower expected returns, estimated as cost of capital, so a negative relation. And among the papers with a neutral relationship, we have, for instance, McWilliams and Siegel that show that after taking into consideration capital expenditure and other measures, there is a neutral relationship. The thing is, As there are many papers analyzing the same pattern, the same relationship, then it's even more interesting to look at some meta-analysis. For instance, this conducted from Liu et al., that basically what they realize is that the results are really mixed, but maybe the point here is that this relationship is not static, but it changes over time, and that's the thing. So all these papers are right in this way, but they are looking at different methodologies or different periods of time. So for instance, Links finds a positive relation during crisis, and the paper from Elgo doesn't include the last crisis we had. But if this is really true, so if the CSR premium is really time varying, so the question is, what drives this time varying premium of CSR or sustainability investments? So our prediction in the paper is that this is related to the level of investor sentiment. So coming back to Baker and Vogler, basically they show that a wave of investor sentiment have larger effects in firms with valuations more difficult to value, and also firms with higher arbitrage costs. So the idea is that when the sentiment is high, so the prices are very disconnected from the fundamentals, from the reality, such as before the crisis in 2008, and everybody is overly optimistic. The prices of the stocks go away, but it's not possible to short sell some of these stocks that are very difficult to arbitrage, and then the prices of these stocks keep too high, and then the expected returns decreases in these periods. And that's exactly what we expect from the CSR firms, because they tend to be harder to arbitrage and more difficult to value. But why is this the case? So one of the most motivations from the side of arbitrage costs come from our discussant, the paper co-authored by Cincinnati and Becchetti. They basically find that firms with a higher CSR intensity have higher idiosyncratic risk. And idiosyncratic risk is maybe one of the most important proxies for this arbitrage costs, because firms with this kind of risk are very difficult to short sell and very risky to do so. And the argument of the authors are very appealing. Why CSR firms can be riskier than other firms? And the argument is that basically, if you have two firms, two similar firms, and there is one firm that invests more in CSR, part of the resources from this firm is already there. So the firms that invest CSR are less flexible to deal with these productive shocks and demand shocks and so on. So they are less flexible because part of the budget is already invested in CSR activities. And the other thing, the other side of this wave of sentiment talks that firms that are more difficult to value also have these characteristics. And what we also expect is that CSR firms also fit these characteristics. We also show in the paper that firms with higher CSR tend to have a lower profitability, higher asset growth, which are characteristics also meant from Baker and Vogler that are firms that are more difficult to value. And more importantly, we can show in this graph that maybe one of the most important proxies for difficulty in evaluating these firms is the intangible assets. And it's expected that firms that invest more in CSR or CR activities, they also have to invest more in tangible assets. Part of their assets are not so tangible. So basically here we show a graph basically showing this relation. So it's a graph created with firm and time fixed effect. And here we show the fitted value given the CSR score. So the higher the CSR, the higher the intangible assets. And we find the same pattern with idiosyncratic risk, which is in line with the paper from Becchetti. This is more like this second part here is more like a replication, but we got exactly the same results. And so in other words, we strongly believe that these CSR firms tend to be more difficult to value, more difficult to arbitrage, and because of that, they are more prone to the level of investor sentiment. So what we do in our paper, so basically we reassess this relationship between social performance and financial performance, but by including two new dimensions. So the first dimension is the time dimension. So we want to analyze what happens over time with these firms. And more importantly, when we talk this in the short term, what's the effect of investor sentiment? We want to analyze if these firms are more prone to investor sentiment. And another point that it's also very important to take into consideration is that in the past, in the prior researchers, more particularly more in the past, so the environmental part was basically just a subset of CSR activities. So the environmental part was not taken into consideration too strongly. And now with all that climate change and all these things related to environmental issues come to our knowledge, so we also consider in our paper to create an analysis with corporate environmentally responsible investment as an integral area. So we treat this as important as CSR per se in our study. So when we talk about the data, it's very standard. So the data of stocks is from CRISP and Compostat. It's a US sample. The data for the ratings is from MSCI Stats, which is one of the most important sources for CSR ratings. And when we calculate the CSR scores, CSR ratings, we take into consideration these 6 qualitative issue areas, so the environmental, human rights, employee relations, diversity, and products. And when we talk about investor sentiment, as I mentioned, so in a way, how to interpret investor sentiment, it's an index that shows how much the market is disconnected from reality. We use the index created by Baker and Vogler, Journal of Finance 2006. And this index is based on 5 proxies that shows how much the market might be disconnected to reality. For instance, number of IPOs and first-day returns of IPOs is 2 very important proxies. And not only that, dividend premium, closed-ended funds, and equity share in new issues. So these are 5 proxies that basically they orthogonalized with some macroeconomic variables. They take out all the correlation with macroeconomic variables just to take what's the part related to this overconfidence. And they basically use principal component analysis to create this sentiment index. And our sample covers 1992 to 2017. So basically we have a 25 years sample. So it's actually 15 years sample, but it's a long sample in terms of sustainability. Yeah, sorry, 25 years, yeah. How we create the sustainability premium? So basically, the methodology, we try to follow the standard methodology in finance. So for instance, the CSR premium, we sort stocks every year based on the CSR ratings. We create 3 portfolios, and then we calculate the returns of the portfolio with the highest CSR score minus the portfolio with the lowest CSR score. So it's a zero investment long-short portfolio, so we can calculate with ex-ante data what's the future returns. So there is no look-ahead bias or anything like that. And we use the same decision of breakpoints as FAMA range and Baker and Vogler, so the 3rd and the 7th decile. So these portfolios are rebalanced once a year. For the CER is the same, but instead of using CSR ratings, we use CER ratings, so just the environmental dimension. And just to clarify, as sometimes we talk CSR premium, CAER premium, and so on, we just call it in our paper that these are 2 different proxies of sustainability premium that are taking into consideration the social responsibility and the environmental responsibility. So the first question we want to solve is, what's the result or the return of the sustainability premium in the long term? So what's the effect of this? So basically here, just to have an idea, so here we calculate the returns of the portfolio with high CSR, here the low CSR, and here is the CSR premium. And as you can see, the CSR premium over this 25 years time period is indistinguishable from zero. So it's the same if we use just excess returns, and if we control for some asset pricing models such as capital asset pricing model, or the 3-factor model of FAMA range, or the 5-factor model of FAMA range, we find exactly the same patterns. and for the CER is the same. So in other words, we find no evidence that firms with higher CSR or higher CR activity, they have a higher return. This is very consistent, for instance, with the theory of the firm, with the idea that if some firms have some economic profit by investing in CSR, basically the competitors also can invest in the same activity, and at the end of the day, this economic profit disappears. But the thing is that other papers also find some, might find some poor economic profit by investing CSR. But then there is this recent paper from Peterson 2020 that argues that even if you find some activity that leads you to have a higher economic profit in the long term by investing CSR, what happens is that some ESG or CSR aware investor can adjust the price of the stock according to this economic profit in a way that the effect in returns in the long term can also be neutral. So basically this is pretty consistent with the literature, either with the idea that the competition reduces the profit, or with the idea that even if you have indeed some profit in the long term, basically the market adjusts this to the price of the stocks. But what happens when we look at the sustainability in the short term? So as I mentioned to you, what we predict in our paper is that firms with higher CSR and CER activities are more prone to investor sentiment. To show you what's the intuition of this, we create a graph to show you what's the idea. So we predict a negative correlation between CSR activities and investor sentiment. So in this graph here, in the shaded areas, we have the periods with low sentiment, and in the white areas, periods with high sentiment. And look what happens. So in periods with low sentiment, the CSR premium is very positive. And in periods with high sentiment, the CSR premium is very negative. And you can really see this pattern over time. So it's not like the CSR premium, it's always positive or always negative. It changes a lot over time. And the worst period of the CSR premium was exactly in the last years when we have a higher period of a lower period of sentiment. Yeah. So yeah, exactly. So basically, and then here was the only exception, and here you could see that we have a lower period of sentiment, and then once again the sustainability premium performed better. When we look at the regressions here, doing more like a scientific approach for that, so basically the regressions reproduce exactly what we find by this graph. So the first two regressions we are running without controls and with controls, where CSR, just by looking at the CSR score, has effect on the next month returns. And consistent with the idea that there is a neutral effect of CSR in the long term, we find that the coefficients are indistinguishable from zero. So it's basically we don't find a correlation in the long term of CSR score and returns. But look what happens when we interact the CSR score with the level of sentiment. So in periods where the CSR score interacts with high sentiment, so the higher the CSR score during periods with high sentiment, the lower the return. And when we look in periods with low sentiment, then we have a positive relation. So basically, it seems that this pattern is really in line with the idea that CSR firms are more prone to investor sentiment. So when the sentiment is very high, these firms tend to be also very high because prices are very high, because these firms are more difficult to arbitrage, and basically the expected returns in these periods tend to be very, very low or even negative. And when we look the same pattern for the CR score, so the environmental part, we also find the same pattern. So we don't find a reliable relation of the CR score in conditional to sentiment, just the CR score and returns. But when we interact this with a high and low sentiment, once again, we find a very important difference. So in periods with high sentiment, the coefficients are negative, although they are not statistically significant. And in periods with low sentiment, then we find a positive and significant effect. But this is a regression at the firm level, so we are weighting all stocks in the same with the same weight. So it could be that this effect comes only because these firms are too small, are driven completely or results. So in order to have a better overview of the economic magnitude of this effect, we also want to analyze this at the portfolio level. So basically, we created portfolios of CSR and CER premium, and look what happens. So the CER premium in periods with high sentiment is negative. So if you invest in firms with higher CSR, you have negative returns in periods with high sentiment. For the CER, it's the same. So it's also negative. It's not statistically different to zero, but it's also negative and aligned with this view that in periods with high sentiment, we have a negative return. On the other hand, in periods with low sentiment, we see the opposite direction. So basically, in periods with low sentiment, the CSR score is positive. It's almost significant at the 10% level. And the CER score, then it's strongly significant even at 1% level. And look what happens when we compare periods with high and low sentiment. So basically, we have a very strong and robust result here. So just as a comparison, for the CSR firms, we have 70 basis points higher returns in periods with low sentiment as compared to periods with high sentiment. So 70 basis points per month, it's more than 8% per year. And for the CER, it's the same pattern. So basically, we have 80 basis points higher returns in periods with low sentiment or following periods with low sentiment as compared to periods with high sentiment. Okay, and if we look at the other qualitative issue areas, we also find a similar pattern. It's not so strongly significant, but it's also aligned with the idea that this other qualitative issue areas also seem to be a bit more prone to investor sentiment. But here we just compare this with excess returns. So we are not running against any asset pricing model. So it could be that this effect of investor sentiment on this sustainability premium are driven by some kind of risk that are more pronounced in periods with high or low sentiment. So in order to analyze what happens if we control for some risk factors, we ran 3 different specifications. So the first specification, we regress based on the Sharp-Lintner and Black model, so the capital asset pricing model. And we still find strongly significant difference of returns in periods with high and low sentiment. If we regress against the 3-factor model, so here we also include the size and the value factor, it's also significant. It drops a little bit the significance because of part of this relation can be explained by the size and the value effect. And then if we use the 5-factor model of Fama range, the CSR drops the significance, but it's almost significant at the 10% level. And the CER is still strongly significant. Even at 5% level, we still find 53 basis points difference of returns conditional to the level of investor sentiment. So in other words, when we analyze these traditional asset pricing models, we are not able to fully explain this effect of investor sentiment on returns. So it seems to be the case that either this is really a mispricing and it cannot be explained by factor model at all, or another alternative is simply that these traditional asset pricing models are not able to explain what happens with this new dimension that we are analyzing, that this is the sustainability dimension. And this idea of creating a new sustainability factor is also reinforced by this recent paper from Pastor from the Journal of Financial Economics that really claiming for researchers to create a sustainability premium that really can take into consideration this new area. So nowadays we cannot only look like this paper from Peterson. So what he defends is that when we are going to analyze investments, previously we had only 2 dimensions, so it was only risk and return that matters. But nowadays there are 3 dimensions, so it's risk, return, and ESG. So basically that's the idea that we want to do by creating a sustainability factor that can better explain the returns of these firms with regard to this new dimension in investments. So how do we construct the sustainability premium? So basically we have 6 qualitative issue areas. So as I mentioned, environmental, community, human rights, employee relations, diversity, and product. And from these 6 qualitative issue areas, we create 12 portfolios. So we have a portfolio with high environmental, low environmental, high community, low community, and so on and so forth. So we have 12 portfolios. We use the same methodology with the same breakpoints, the 3rd and 7th breakpoints, to decide which stocks are in each of these portfolios. And then basically we have these 12 portfolios, and we use principal component analysis, which is a method to have a dimensionality reduction that basically identify and isolates what's the principal components from these components of data. So just as an example, we have this graph here with a lot of data points, and principal component analysis wants to analyze what are these data have in common. This would be, for instance, the principal component, and the second component should be orthogonal to the first and should explain another dimension of the data. So when we ran these 12 portfolios with principal component analysis, this first part here basically shows that more than 95% of the variance of the returns of all these 12 portfolios can be explained by 2 components. So we don't need many components to explain the returns. So 95% of the returns can be explained by these first 2 principal components. And what are these 2 first components? So the first component is very straightforward. So what all these 12 portfolios have in common? They all have stocks, and stocks are correlated to the market. So basically, the first component is basically a proxy for the market return. The second component is the most interesting for us, because basically we want to know what happens in terms of this new dimension, which is the CSR dimension. So what we expect here is that for each of these qualitative issue areas, we have opposite signs for this portfolio with high and low sustainability, with high and low environmental, community, and so on. They should be opposite. And so what I would expect by running this PCA with this 12 portfolios is that maybe the most important dimension is the environmental. And that's exactly what we find. So here are the weights of the second principal component. And look, so basically when we compare environmental high and low, the signs are opposite, community, and so on. Once again, the environmental part has the highest weight, and this is a very, it seems to be a very good candidate to really incorporate what all these 12 portfolios have in common. And we construct this sustainability factor by simply multiplying the weights of these portfolios by the returns of these portfolios. And before we analyze this portfolio, just to have an idea, so if we simply regress the CSR premium on the lagged investor sentiment, we had very strong and significant returns. So basically it was negative, as I mentioned, so it's a negative correlation, and you have negative coefficients for the CSR premium and also the CR premium. Look what happens when we control it for the sustainability factor. So when we add the sustainability factor in the regression, first, it's important to mention sustainability factor is strongly significant. And look, it subsumed completely the role of investor sentiment on this return. So investor sentiment becomes completely indistinguishable from zero. And remember that the returns conditional to the level of high and low investor sentiment was strongly significant. In the case of CSR, was 70 basis points different and strongly significant. Here, basically, we find is that After we include the sustainability factor in the regression, this becomes indistinguishable from zero. So it really is the case that this sustainability factor really can explain what we previously thought as a mispricing, but basically this can explain this effect of investor sentiment on this new dimension of investment. And what happens with CR, because CR was even more pronounced the effect of investor sentiment. But even so, once again, so investor sentiment becomes completely indistinguishable from zero in all regressions. So in other words, this sustainability factor that we propose in our paper really can explain a lot of derivations and a lot of patterns that we see in the returns related to firms with high and low CSR or CER premium. So just to conclude, so basically the three main takeaways from the paper. So in the long term, we do not find any positive or negative correlation. So we find like a neutral correlation between CSR activities and returns, and this was robust across all our analysis. But on the other hand, we find in the short term that the returns of these firms more related to sustainability tend to be prone to the level of investor sentiment, at least in the period that we analyzed. And this is a very important point in terms of study, because people didn't take into consideration that behavioral finance also could have a lot of implications on CSR investments. So not all investors are completely rational. So another way you could look at these results, if you don't believe that the market is efficient, it's, let's say, but one intuition you could have is that when the sentiment is very high, everybody is very optimistic, and then basically people invest more in CSR, and then the prices are too high and the expected returns are very low. And when the sentiment is very low and the market is in a crisis and so on, so people tend to not take so much care about CSR investments anymore, and basically the prices are lower and then the expected returns are higher. So basically there are a lot of effects of behavioral finance, and that could help us to really understand what is this new dimension in finance. Because really CSR or ESG, how you prefer to name it, basically will really change completely the investment industry. And this is a very important point that we really have to understand more. And finally, we also propose the sustainability factor with a PCA model. After we include the sustainability factor, basically it can explain completely the effect of investor sentiment and the returns of these firms. So thank you so much for your time, and I'm looking forward to see the discussion from Professor Ciciretti.
Hi, Vito. Thank you so much for your very interesting presentation that show sure that, for example, asset margin model is not able to explain many factors, in particular factor like sustainability factor. And so it's a welcome research like this, also research that explain the impact of behavioral finance, and in particular investor sentiment in the function of financial market, of the real financial market. So we can move to the discussion by Professor Rocco Ciciretti. Welcome to us. And I don't know, Victor, I think that you can say, okay, perfect. Please, Professor Rocco.
Thank you, Daniela. Thank you, Vitor, for your presentation. And it was a nice paper to read. So I will not summarize because I have, let's say, 10 minutes. And it's interesting how you use principal component, let's say, in time-varying approach to talk about the ESG assets and ESG risk premia. But let me say, I don't want to quote too much myself, but we published in 2018 in Journal Financial Stability the CSR or ESG risk factor isolated using the Fama French methodology, just to to see the difference when you use the standard multi-factor model. So my first concern, and to build a paper on a strong basis, is that I want to talk about in the motivation part that why you study this phenomena using principal component over time is because there is a positive, negative, or neutral results so far. But my main suggestion is that why don't you push that you are trying using principal component instead of Fama-French approach to isolate the ESG factor, or risk factor, instead of talking about what are the results previously done. And then, because you want to isolate, you want also to show how your approach is different from the multi-factor.
I see.
Yes, the multi-factor approach. So what is the added value of principal component, and also why you use principal component in the same regression where the other factor are built using the standard methodology. So my idea is that the value is after you isolate, so after you taking care of the idiosyncratic, the systematic component of introducing the ESG, what is the right measure of the idiosyncratic one if you correctly isolate the ESG. So the idea of the short long run is in the literature already, as well as the one of ESG risk factor. So my conceptual concern is that you really want to show what is the underlying risk that can originate the anomaly captured from a risk factor using Fama-French or using your methodology. So mainly you want to push if the principal component is able to correctly isolate what you're really looking for and what is the market is not doing so far. So when you build your risk factor, I believe as a reader to see what is your justification with respect to the standard approach, and what is then your added value with respect to the Fama-French methodology that I call, let's say, the standard methodology. So my point is, what is the contribution in economic term of using principal component instead of the standard approach, and what is also the result when you run in the same regression factor coming from the principal component with respect to factor coming from the standard approach. In addition to that, when you talk about time varying, actually reading the abstract and the introduction of the paper, I was expecting a more like rolling window analysis instead of high and low sentiment period, because I believe that rolling window is a dynamic approach that can give, let's say, to the paper and to your principal component also the analysis that is underlying the risk factor creation, because you readjust portfolio every year. So my point is, in your first months of low sentiment, are you adjusting the portfolio using the previous year of high sentiment? This is maybe more technical, but give the idea that I have behind my suggestion. And so I really believe that you should consider either to implement this analysis in a two-step or implement the standard Gibson-Ross and Schengen test to show that your methodology, is also able to price the cross-section of the return. in the risk when you build the risk factor. And I believe that then I have some minor comments, but my concern is that you should motivate better your paper, showing that the main analysis is to isolate something that the market is pricing. Now, whatever methodology you use, you want to be sure that the way you isolate help you to correctly price what is left over. That is, of course, the idiosyncratic component when you correctly isolate the systematic one. And in a time varying, I was expecting a more dynamic time varying approach. That is something that you can really give a contribution in the literature. So this is my my discussion, and I hope it will help to raise the bar of your paper. Thank you very much.
Thank you so much, Professor Ciciretti. It's a pleasure. And yeah, it's some points very well taken. Indeed, so it's important to so for us the idea was kind of straightforward to use PCA because we really wanted to isolate the effect of sustainability, but for the reader, indeed, it could be not so straightforward that why we are using a different methodology to capture this new dimension in comparison to FOMA French and your paper. Very well taken. The part of GRS factor, it's also a very nice point. It's we also can include. I use GRS in other of my studies, and we also could include. So we find no evidence that the alpha was indistinguishable from zero, but in any case, it's another test that could be well taken. And also for the time varying approach, it's a very important point. So the level of investor sentiment, we strongly we followed the methodology from the paper from Istanbul, probably you know, from the JFE, that basically sorts as a time constant investor sentiment, and he sorts in periods with high and low sentiment. But indeed, it could be interesting for the reader also take into consideration this another approach to also to analyze the sentiment and the sustainability premium. So thank you so much. I appreciate these comments.
Thank you.
Thank you so much also to Rocco Ciciretti, professor, because really professor gave a discussion very specified, and also is a discussion that gives value and give a lot of suggestion to this very interesting research. Now we have time, so if there are some questions, please. Incredibly, we are on time. We are welcome every question that you are, or curiosity, for example. This means that everything it's fine, everything it's clear.
Okay, this is Carlo Emilia from.
Oh, thanks, Carlo.
Thank
please.
You. Well, thank you, Daniela. I have enjoyed the presentation and the comments. Very rich of insights, and so I have to look. I am not familiar with this literature, so I'm very happy of this presentation. I have a question. This a bit more general about the economics. On if you can elaborate a little bit more on the reason, this relationship between this G premium and investor sentiment. Why should it be inversely correlated? And thank you very much.
Okay, thank you for the question. It's a nice time to talk about it again. So basically the idea is that investor sentiment, as I mentioned before, it's a proxy of how much the market's disconnected to the fundamentals. Sometimes it's above the fundamentals, sometimes below the fundamentals. So when the sentiment is very high, it's because everybody's very optimistic about the market and prices are very, very high and so on. And what happens is that in periods with very high sentiment, it's some firms or some investors really tend to are not so, let's say, the price of these stocks are really disconnected to the reality as well. And then some stocks with some particular characteristics tend to have a very high price. A lot of investors push the price very, very high, and for these particular stocks are very difficult to bring the price back to the reality. Why? Because basically when the prices are too high, the only way you can push the price back to the correct price, so let's say the correct price is that and the price in periods with high sentiment is like that. So the only way you can push the price to the reality is by short selling these stocks. And short selling stocks that have these characteristics that are very high idiosyncratic risk, a lot of intangible assets, so these stocks that are very difficult to arbitrage, it's more difficult. And for this reason, in periods with high sentiment, the prices are too high for these stocks, including firms like with high CSR, and once the prices are too high, the expected returns on the following periods tend to be very low. And the opposite happens when the sentiment is very low, so then we also have the opposite direction. So basically that's the idea. So when the sentiment is very high, the prices are also very high and the expected returns shrink. That's pretty much the theory of investor sentiment.
Okay. Thank you. Yes, I missed probably the first part of your presentation, so thank you for repeating.
It was a pleasure.
Thank you, Carlo, for your question. Now there are
a question. May I?
Yes.
I wonder if you could do a small, short focus on diversity, on the role of diversity that I seen in a chart.
Okay, may I share the screen again? Let me see if I can share the screen.
Just a minute.
Okay. So, okay.
Yeah, you are.
Okay, yeah. So diversity is also a very important area when we talk about sustainability and so on. I mean, the study was not completely focused on diversity, was more like a broader or a wider view of sustainability. But when we talk specifically about the relation of diversity and investor sentiment, we didn't find any relation at all. So basically, we cannot say that firms with higher or lower diversity are more prone to investor sentiment. So when we look particularly from other qualitative issue areas such as community, employee relations, product quality, we indeed find some evidence on that. But diversity we didn't find. And when we also analyze the returns of firms with high diversity and low diversity, what happens in returns in the long term, some of the analysis of the paper, and we did not find any relation in the long term. So basically, at least in the data set, in the time period we analyzed, we saw like a neutral relation with return, which doesn't mean that this is not relevant for the firm. We are seeing every time more some cases with that basically firms can create a lot of value with diversity. That's at least my view I have. So in Brazil we had some cases recently with racism and so on, and the prices of the stocks of Carrefour and so on really dropped a lot after this case, and I strongly believe that it could have some effect, and some firms can really generate value, but we did not find any of this evidence in our study.
Okay, thank you.
There are other questions on everything. It's okay now. Okay, I think it's time to end. Very interesting paper, and we hope to have the opportunity to see in the future new research, because we know, as you know, the topics are very interesting now. It's also in particular for regulators, and so. I would like to thank you again, and to thank also Professor Ciciretti and all the participants of this webinar. Thank you so much. See you soon. Bye.
Thank you so much for organizing it.
Thank you very much, Daniela.
Thank you.
Bye.
Bye.
Bye bye.
Bye bye.